and the people who are renting at the bottom end of the income scale are going to have serious trouble. And mobile home parks are a really good way to solve that. But there are a limited number of them. Most of them are run by mom and pops. Most of them are significantly undermanaged, have tremendous opportunities for increased income. And I don't mean just by raising rents up to market, but by filling vacant spots in the mobile home park community is a big way to add value.
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck. And today, just like every week, we have another incredible guest. Paul Moore, he's been in the business 25 plus years. This show goes through, residential into commercial, into being a boring investor, and actually how to help fight human trafficking. So before I bring Paul on, I always take a little bit of time to thank you for being here and appreciate you for anything that you can do to help spread the message. And again, anything I can do to help you, look me up, generationsofwealth.com, derekdombeck.com. Just send me an email, derek@globalgow.com. Whatever I can do to help you, that's what it's all about. So with that, let's get on with the show. And here he is, Paul Moore. Paul, thank you so much for giving us some of your time today. How are you doing, buddy?
I'm doing great. How you doing, Derek?
It's another day. The heart's beating, the sun's shining. What can we complain about?
Yeah, you bet.
Why don't you tell the audience a little bit about yourself? You've got a very, very extensive background and have been around for quite a long time, and I'm really looking forward to this conversation.
Yeah, me too. Well, I started out with, I got an engineering degree in college, which was my first of many mistakes. Uh, went on and got an MBA, went to Ford Motor Company, really enjoyed Ford, but I just figured out I wasn't cut out for a large W-2 career. And so I left there after 5 years, started my own company, and providentially we were able to sell it to a public company in 5 years. And I thought, hey, I'm a full-time investor now. And my family moved to the Blue Ridge Mountains from Detroit to the Blue Ridge Mountains of Virginia, where we started a nonprofit. And I also started flipping houses and doing all kinds of other investments. And you know what pretty quickly learned, Derek, that I wasn't investing at all. I wasn't an investor. I was a speculator. I was foolish. I was a shiny object chaser, and I lost a lot of money. I actually made money and I lost a lot of money. And the lessons I learned were really painful. Fast forward 15 years, started a podcast, and I was co-host of a podcast called How to Lose Money, which was a wealth building podcast we had 238 guests telling us their painful stories of loss and terrible things that happened to them on their way to success. That was fun. And been in commercial real estate for about 14 years, and we're about to launch our 8th commercial real estate fund at Wellings Capital. So that's a quick overview of me.
Yeah, and I know you've put out some books. You've been a regular, I guess, information source for Bigger Pockets and other things like that. So you definitely you've taken some lumps. Most of us teach because of stuff we've been through more than things that we've learned the easy way, right?
It's so true. I don't know if we really learn much outside of pain and losses. What surprised me, I think it's easier, Derek, to not to imitate people's not I'm saying it wrong. I think it's easier to avoid mistakes than it is to imitate success.
Mhm.
So much of success, if you look at the Google founders or Facebook or, Elon Musk, so much of it was providence and luck and being at the right place at the right time and just their towering intellect and things that we can't really imitate too easily. and some of them can't imitate it. Some of the greatest inventors and investors haven't been able to replicate their own success sometimes. Um, but I think if we can study people's mistakes and avoid those, it's a lot easier. That was one of the themes of the How to Lose Money podcast. And what I didn't know when we did the podcast was Bill Gates and Warren Buffett consider Charlie Munger the greatest, smartest investment mind in the world. And of course, he passed away about a year and a half ago. But Charlie Munger's obsession was not in creating complex algorithms, not in using his towering intellect to create all kinds of really hard to imagine puzzles to solve in the investment realm. He said his obsession was to avoid other people's repeatable mistakes and avoid his own mistakes. Munger said Munger used to rub his nose in his own mistakes. Imagine, the second the guy who's second in command at Berkshire Hathaway standing up in front of 40,000 Berkshire Hathaway devotees and said, "We were horses' asses.
Mhm.
We blew it. We messed it up for you, and we're sorry." And then he said, "But we're not going to make that mistake again if we can help it." And so it's pretty amazing to think about, the role of mistakes in our life. They can either make us bitter or make us better.
Well, and the people that I like to spend time around are the humble people that are willing to talk about those mistakes, not the people that are beating their chest, bragging about how good they are, because
Yeah.
we all know they're full of shit. I
Yep.
mean, it's just a fact. And you mentioned something a little bit ago that I want to touch on is you lost, money on a lot of your transactions, your flips, what have you. And I know for 21 years that I've been in this business, I don't do a good enough job myself. I don't think most of us do, but actually knowing what you make on a deal, whether it's a flip or your rental or anything else, right? Like I can ask people, what is your acquisition cost to get a deal? And they don't know. They truly don't know what it actually costs them, right down to the penny per deal. Now, when you start talking like in your world commercial, it's on a much grander scale, and you would think, okay, Paul and people like you are doing large commercial deals. They must have it dialed in. But Paul, I know so many people that are in commercial deals that still don't really know their numbers. And I'd love to hear your opinion on that, because I believe a lot of people, especially in the last 5 years in this business, have been making money by luck rather than skill and proper decision making. But what do you think?
Well, to comment on your last comment, the famous saying, the rising tide lifts all boats. And we saw that especially since the mid-teens up through 2022. A lot of syndicators who were brand new and honestly didn't know what they were doing made a lot of money for their investors. And amazingly, they made sometimes double the amount of money that a seasoned professional would make on the same deal because they took sometimes twice as much risk. They had an extremely high loan to value ratio. They used risky floating rate debt with no exit penalties, and by doing that they were able to make enormous profits. But of course they were first in line to lose money when the tide turned. Warren Buffett said the rising tide lifts all boats, but someday that tide's going to go out and we'll see who's skinny dipping. And of course we all saw that. There were so many examples of it since 2022. But back to the question about how much, knowing your numbers, Warren Buffett also said that accounting is the language of business, and you need to know accounting inside out. And Buffett amazingly knows it. Like he's able to do all these calculations in his head. He doesn't even know how to use Excel, to my knowledge. And yet he's, if you took, and he's a guy who knows the numbers super, super well, obviously. If you took the last 60 years in the S&P 500 and put it up against Berkshire Hathaway, Berkshire Hathaway could lose 99% of its value. That means if it was $100 a share, you could strip it down to $1 a share, and they would still wallop the S&P 500 by about a 40% win over the last 60 years. So Buffett knows what he's talking about. You know what you're talking about. You've got to know your numbers.
Yeah, and it's easy to, even us guys that have been in the business 20 plus years, it's easy to fall out of that routine if you're not careful. We
Hmm.
all get sucked into shiny object syndrome and, chasing deals. I'm a deal junkie. I shout that from the rooftops. That's my high that I live for. And I don't like paperwork, So it's sometimes it is easy to just get involved in the deals and lose it. But when you start becoming one of the things that you talk about, a boring investor, right? Like you, and we're going to touch on that in the coming minutes here, but as a boring investor, I imagine it is 100% about the numbers. It's not about being a deal junkie. But before I get you into that, talk to us about your shift from residential into commercial. Why do you feel like commercial, assets are perhaps better, or at least what people segue into?
Well, at the risk of sounding like a broken record, I'm going to quote Buffett at least once more. Buffett said, if you don't learn to make money while you sleep, you'll have to work until you die. And our company, my buddy and I flipped, about 50 or 60 houses, 30 or 40 waterfront lots. I built 7 or 8 homes, which was a big mistake for a guy who doesn't know how to tighten his own doorknob, by the way. Um, but anyway, the what we found in that is we were just continuing recycling money, and we weren't really making money while we slept. And so 2008 was a big wake up call. I went from $1.5 million in the bank to 2.5 million in debt. And that was a very tough time in 2007, 8, and 9. But we ended up debt free without any kind of bankruptcy or anything else right in the middle of the Great Recession. Um, but that around that time, decided we really wanted to make a shift into commercial real estate. Con, flip houses or individual houses are, they're based, the values based on comps in the neighborhood. And while commercial real estate certainly has an element of that, commercial real estate is based largely on math. And the value formula, as most of your listeners probably know, the value equals the net operating income divided by the cap rate or the capitalization rate. And keeping the cap rate essentially constant, if you can increase the net operating income, then you can drive or force increased value in an asset. And that simple math formula is the key to a lot of people building a lot of wealth in commercial real estate.
So what are some of the common mistakes that, first time commercial real estate investors make? How can they avoid making those mistakes if they're just starting to get interested in it?
Well, if you're a passive investor, I mean, let's put it this way, nobody wakes up in the morning, with a plan to bankrupt themselves. And in a similar way, no commercial real estate syndicators deal that I've seen ever looks bad on paper. All their websites are nice, all the deals look nice, all the IRRs look strong. And it's really critical to look past your emotions and to somehow, get into the logical left brain side, but still have a right brain component. So when our company, we don't operate any deals. We do due diligence on sponsors and deals. And for example, last year in 2024, we evaluated 745 deal operators and deals, and we only invested in 5.
Mm.
Now, I'm more like maybe like you were. I'm more the deal junkie guy, and I get to know people, really like them. I trust them quickly. I bond with them quickly, and I want to invest in their deals by nature. So if you understand, if if your listeners know the traction concept, Gino Wickman put a book out about a dozen years ago called Traction, and there's a system called EOS built around that, which says that you need I'm going to call it a left and a right brain person, but it's really a visionary and then an implementer, an integrator. And those two together can make a great team. And I was fortunate enough to meet a guy at 20 years old. I was around 50. He was 20 at Liberty University in Lynchburg, Virginia. He became my business partner over the last decade. Now he's in his 30s, and he is an extreme integrator, extreme left brain. His job is to say no to almost everything.
Mhm.
And so I'll come to him as I did yesterday and say, "This is a great guy, it's a great company, you ought to check it out." And his default is always to say no. And I think that's the biggest mistake people make in commercial and other types of real estate. And that is their default is to say yes to everything. And the right answer is to say no to everything up front and then let the numbers and let the checklist prove itself out. We have a 27-point due diligence checklist. And unless something checks off virtually every box, we say no to it. And that includes a right brain box, and that's gut feel. If I have a bad gut feel about somebody and everything else checks out, I'm usually best off saying no to that. And my partner's especially good at it.
And it sounds like a great partnership because it's checks and balances for each
Yes,
other and the due diligence.
right.
So for first timers coming in, they've got to probably know their own strengths and weaknesses and maybe find, it doesn't have to be a partner, but find another sounding board or another person that they can run a deal past
Yeah.
to be those checks and balances, right?
Yeah, that's absolutely right. Like I said, my default in the early years as a shiny object chaser, as a non-boring investor, was to chase exciting investments that looked fun. Charlie Munger said, "We don't chase anything we don't understand. We don't want to leap over 8-foot hurdles. We want to step over 1-foot hurdles." It's really quite simple. And when it's complicated, we just say no.
So moving forward from that point, you've got deals that you do want to invest in. What are you interested in nowadays?
If I had to pick one asset type, and you didn't ask this, but if I had to pick one asset type of the six we invest in, it would be mobile home parks.
Okay.
We invest in self-storage, mobile home parks, RV parks, multifamily, a few retail strip centers, and light industrial. But the one thing you can say is I don't know of any other asset type that has a decreasing or static supply every year, but an increasing demand every year, like mobile home parks, manufactured housing communities, whatever you want to call them. Um, there really is an affordable housing crisis. It's getting worse. The numbers I just reviewed this week from CBRE it's stunning how significant this affordable housing crisis is going to get in the next decade. And I don't see any way out of it. And the people who are renting at the bottom end of the income scale are going to have serious trouble. And mobile home parks are a really good way to solve that, but there are a limited number of them. Most of them are run by mom and pops. Most of them are significantly undermanaged, have tremendous opportunities for increased income. And I don't mean just by raising rents up to market, but by filling vacant spots in the mobile home park community is a big way to add value. Um, 10,000 people turn 65 today, Derek. Yet 6,000 of those 10,000 don't have $10,000 saved for retirement. But
Yeah.
some of them have home equity and they're willing to trade that in for to buy a mobile home, that might be 30, 40,000 or less used, or 50 to 75,000 new, and put it in a mobile home park for, $400 or $500 a month compared to a $2,000 rent in that same community for apartment. And with a mobile home, they get 3 bedrooms instead of 2. They get their own parking spaces right out front. They get a deck, they get a yard, they don't share a wall with a neighbor, and they have something that they can call home for the rest of their life. And it's not only low income people doing this. I know a prestigious doctor who retired and moved out of a home to a mobile home, and he enjoyed traveling and low maintenance, and he did that the rest of his life.
Well, and the other aspect of that is they actually own the home and someday they can sell it
Right.
versus having that rental. So,
Yes.
well, and personally, I like, the RV space, and, it's something that I'm actively always looking for. I have a lot of friends that are in storage, but storage is a lot of competition. I tend to try to go after stuff that nobody else is really going after. Um,
Yeah.
whether it's residential or commercial. But
Yeah.
I don't love apartment complexes. Personally, I think that they are so underwater at this point, and there's so many. Now, that being said, there's a lot of people that are going to lose money, and those properties will have to be liquidated, and a lot of syndications that are going to lose money. The investors are going to lose money. The
Yeah.
banks are going to be fine because they're at 70% LTV. But so I do believe there's opportunity coming there.
Right.
Well, let's get into how do you become a boring investor?
The difference between a good deal and a great one, it usually comes down to what you say and how you say it. That's where Elite Negotiations Academy comes in. We help real estate professionals master the art of negotiation through real-world coaching, live deal analysis, and breakdowns of actual calls. Learn how to control the conversation, build trust faster, and close deals without leaving money on the table. Whether you're talking to sellers, buyers, or lenders, this is the skill that pays for itself. Try it out. $49 per month for your first 3 months. Visit EliteNegotiationsAcademy.com and start negotiating like a pro.
Well, like I said, I've already hinted at this earlier, Derek. I chased shiny objects. I looked for exciting opportunities. I think the mistake I made is I went from being a 34-year-old entrepreneur to a 34-year-old investor. And like I said, I was really a speculator. I think I wanted to get the same excitement I did out of investing that I did out of being an entrepreneur. And that was a huge mistake. Paul Samuelson, the first Nobel Peace Prize winner in economics from the US, said, investing should be boring. It should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. So I think boring investors, they attain true wealth, which I define as having assets that generate predictable income. They enjoy real freedom, freedom from constantly monitoring their GameStop or Bitcoin. Nothing against those things, but those generally are not reliable assets that throw off income. They avoid the hidden costs of constantly stressing out over the market's ups and downs, a war in the Middle East, the mood on Wall Street, etc. They learn from their mistakes, which we've already talked about quite a bit. They realize they might be wrong. Up front, they realize, look, I might be wrong. Chris Davis of Davis Advisors has a wall of shame in their office where they have all the stock certificates of all the biggest losses they ever had over their, decades of history, like AIG. And then they'll put bullet points under the stock certificate saying, here's what we did wrong when we decided to invest in this. Um, Boring investors invest in boring assets like self-storage or RV parks or mobile home parks, stuff that's not exciting. Boring investors don't put all their eggs in one basket. They diversify. Um, they don't chase shiny objects. They are simpletons. They really believe that, simple investments, simple, things that are simple to understand. Like I mentioned, Munger and Buffett stepping over 1-foot hurdles. Boring investors trade FOMO for FOMO. FOMO, of course, is fear of missing out, which I always had as an early speculator back in the late 90s when I sold my company. Um, but they traded that for FOMO, which is the fear of messing up. And they eventually get JOMO, which is the joy of missing out. Last year, an asset sold that we had considered investing in back in 2020, and it sold for a massive profit, and we did not invest in it. Actually, we were an investor in one of our funds, but we were going to do a sidecar deal where we were going to plow an extra several $1 million into this. And we didn't, and we regretted it deeply. But then I went back and looked. I found my notes on why we said no to it. And there were lots of things that could have gone wrong. And you know what? I had a little bit of joy that day because I was like, you know what? We stuck with our principles. It could have gone wrong. We didn't do it. And we had the so-called joy of missing out. Now, I don't recommend a lot of that, but the fear of messing up trumped my fear of missing out in that case. And there's many, many situations like that. So that's a few of the ways we can become a boring investor. I want to talk more about that, but I want to take a breath and let you jump in there, Derek.
Well, my only question is, from a boring investor standpoint, what does that look like for rate of return? Whether it's ROI or IRR, what are you looking at from a boring investor standpoint?
You know, our two new funds, one's a growth fund that's hopefully going to be getting in the high teens net returns to investors over the next decade. And the other is an income fund, which will hopefully be getting 10 to 12%. And, I'm 61, and for one of the first times in my life, I'm feeling more and more attracted to the income fund and the stability of, of that lower risk, lower drama, lower potential return. Um, I used to chase things where I could, 10x my money. I remember not that long ago, really, in 2010, that was only 15 years ago, chasing an oil and gas deal. If you remember the Bakken oil boom in North Dakota, not far
Yep,
from you, there were
absolutely.
all kinds of investors making 10 or 20% or more annual returns. When I invested in the Bakken, I invested in a wildcat deal that was on the edge of the Bakken that was, destined to return 100x returns, but it had a lot of risk. And that was super attractive to me. And you know what? I lost all my money in that deal. And I'm just not attracted to that anymore.
Yeah, I've spent a lot of time in that area of North Dakota, but not for investing, primarily for hunting. So
Oh
very
yeah.
familiar with that area.
Yeah.
Um, okay, so if you picked one or two major points, educational points of being a boring investor, what would those be?
Well, I actually, at 61, I've got kids ranging from 31 to 20 years old. And I actually honestly think that I made a lot of mistakes by not investing more in relationships. I always knew how important it was to be a good husband and a good father and spend time with my kids. And my kids are all doing well, really well. But honestly, I have a lot of regrets. Um, who was it? Lee Iacocca from Chrysler famously said, "No one on their deathbed wished they'd spent more time at the office." And I worked 7 days a week for, off and on for years. I would look forward to Saturdays and Sundays because I'd get less emails and phone calls so I could get more work done. I didn't invest as much time in my kids as I wish I had. And I didn't invest in what I would call some of the spiritual disciplines like silence and solitude and Sabbath. And I'm doing that more and more. I'm investing in happiness more. There's studies that say that, and I don't want to argue about the number, but that around $100,000 or more, you're not any happier if you make 200, 300, 400, 2 million, 10 million. You're not any happier than you would have been at about this happiness satiation point, which they say is, let's say around 100,000, call it 150. I don't care. The
Mhm.
point is, if you're already making that much, and most of your listeners might be making that much or more already, why does it really make sense to spend an extra 10 hours at the office? Or does it really make sense to flip an extra house when you could spend that time enjoying your family, enjoying your community? I think boring investors, like I like to say it this way, they invest in the unseen realm where there's apparently no return on investment. Now, a lot of your audience, everybody in your audience has heard of George Washington, but many people in your audience probably haven't heard of William Wilberforce. And I would put forth the possibility that William Wilberforce should be the most celebrated guy in world history for the last 1,000 years at least. He was wealthy. He was the youngest guy ever elected to Parliament at 21 in the UK. He had wealth. He had friendships. He was part of five, country clubs, and he came face to face with the horror of slavery. And he was horrified by that. He changed his whole life, reoriented himself. He quit the country clubs. He traded his health, his wealth, his friendships, his reputation, his time, and he spent the rest of his life fighting to end the slave trafficking, the slave trade, which he was able to do after a couple of decades of very hard work. And then 3 days before he died, I think it was 1833, they outlawed slavery as a whole in the UK, and that spilled over, of course, 25, 35 years later to the United States, where slavery was outlawed here. William Wilberforce invested in the unseen realm, but there was apparently no return on investment for most of those years. He was a boring investor. He invested for a testimony rather than a title. He was friends with the King of England, who had a title, but William Wilberforce has a testimony that will ring throughout history. And I love that about him. And I'd recommend that everybody go watch the movie from 2007 called Amazing Grace, The Life of William Wilberforce.
Well, I've never heard about him, and I appreciate that because that just got written down for me. Um, and I actually want to probably ask you about that if you're willing to share some of it. I know part of your boring investor mentality, and now a lot of, I shouldn't say a lot, but some of your time is going to help awareness with human trafficking and things of that nature. Would you be willing to
Yeah.
touch on that?
Yeah, it's tragic. 200 and what is it? About 200 years after slavery was outlawed in England, we have the highest number of slaves, enslaved people of any time in world history. That's estimated there are about 49 million slaves in the world right now. And here's an amazing statistic, Derek. If you took the record, not the average, the record profits from ExxonMobil, Nike, and Walmart, added up those record profits and tripled that number, that's the approximate profitability of human trafficking every year. And it's a horrible situation. Wellings Capital wanted to do something about this, so we applied some of the same principles we've used to find the best commercial operators and deals. And we did due diligence and we found a partner called AIM, AIM, and their website is aimfree, AIMFREE.org. And they're doing an amazing job fighting human trafficking, rescuing victims. Over 90% of their victims never go back to the street. And that's pretty significant considering that I think with a lot of agencies, over 90% go back to the street because they have no other options.
Mm.
But AIM rescues these little children. They give them a safe place to live. They give them counseling. They give them spiritual encouragement. They give them food, shelter, and job skills. And then a lot of them turn into abolitionists themselves. We just spent 4 days in California with a lot of these folks, and I'm telling you, it's a great organization. I recommend people check out aimfree.org.
I don't talk politics on these shows hardly ever. But one of the things I will say is, there's people out there that want to take from the wealthy to distribute funds the way they want in their programs. But what I look at is, self-made entrepreneur starting off, in college, going to Ford Motor Company, building businesses, building things, and now ultimately being able to put your time and resources into a charity or an organization that you are passionate about. I love that. I've always appreciated that about self-made people versus those that want to take away from the self-made and distribute their fair share, right? I hate that word. So kudos to
Yeah.
you and everybody else, because we all know how hard we work. And when we're able to help, and if it's just we're one person that we're able to help, so be it. But yeah, heart-centered people, that's who I want to be around.
Yeah. Thank you for saying that, Derek. I appreciate it.
Absolutely. Paul, what's this? This is a really hard question. What's one question I should have asked you that I didn't?
I think one question would be, what was the change in William Wilberforce, and what was the change in Paul Moore that made everything, that made me pivot, and that made Wilberforce pivot? And it was basically coming face to face with Jesus Christ and deciding to follow him. And that's something I don't talk a lot about on podcasts, but I just felt like that's what I wanted to say at this point. And that's made all the difference in my life and my desire to help people instead of being selfish. My goals were totally different before that. And they weren't all bad, but a lot of them were self-centered. And at this point, I care less and less about some of the stuff I used to live for, 30 years ago.
Well, that's why I love that question, and I ask that question on almost every show, because so many of these shows, in my show in particular, like I love having just free conversations and they go where they go. But when I get to ask that question, and the way you answered it was amazing, but I could have never scripted that. I could have never thought of that. So I appreciate it.
Yeah, you bet.
Paul, we're gonna wind this up. How can people find you or find out about you, or if they want to get involved in helping you with your human trafficking, different
Yeah.
things? How do people find you?
Yeah, we do an annual giving push for AIM. And if somebody wants to be part of that or be part of the match, we've raised about $900,000 in the last 3.5 years for AIM. And our goal is to raise 5 million in the next several years. So they can reach out to us at Wellings Capital. That's WELLINGS, wellingscapital.com. And if they would like to learn more about investing in our funds or get resources on RV parks, self-storage, mobile home parks, or more, we've got ebooks we've written on those topics and more at wellingscapital.com/resources.
Fantastic. Well, we will have that in the show notes as well. And again, Paul, thank you so much for taking some time out of your day to share your knowledge and your wisdom. It's much appreciated.
Thanks, Derek. It was super. It was just such an honor to be here. Thank you so much.
Absolutely. Well, we'll wind this up. For all the rest of you regular listeners, you know the drill. We appreciate you. Please do everything you can to help us spread the message of the generations of wealth. And if you're just finding us, thanks for being here. And until the next show, go out, do some deals, and be a good person. See ya.